So this is the part of the show where I talk about what I believe is important for individual investors to consider before you make your investment decisions. And as always, my three topics for this show: central banks in a quandary. Why is it so difficult for central banks right now? The Bank of Canada, US Federal Reserve, why is it so difficult for them to set policy, to either raise rates or not raise rates? We'll touch on that. And we'll also speak about why that's important for individual investors to consider. Market breadth. What does that mean? Well, many people have been complaining over the last little while that the breadth of the markets, basically how well the market is doing, is dependent on just a handful of companies. A handful of companies' share prices are moving this market. If you were to remove those top 5 to 10 stocks out of the index would actually be flat to slightly negative. Is this a good thing? This is something, again, individual investors need to consider. And our third point, consider being a contrarian once again. We talk about being contrarian all the time, and I still maintain that being a contrarian investor is the best way to improve your portfolio and grow wealth over time. So let's get to the first point that I'd like to touch on, which is central banks in a quandary. And interesting here, we have, I guess, the most recent, cycle of interest rate hikes over the past year. We have a chart, again, as we show it many times, and we show quite often, that central bank or the Federal Reserve has raised rates a number of times. I guess if you count over the last year and a bit, they've raised 10 times or 5%. And many people believe that it's a 50-50 chance or a flip of a coin whether they raise rates another 25 basis points come June. I think it's actually lower than that. For a little while there, while the data was showing softness in the economy, softness on inflation, I think the chances were somewhere around, less than 25%. Today, some are saying 50-50. I think it's more maybe 35% chance they will raise rates. But why is the Federal Reserve and Bank of Canada in a bit of a quandary? And why is this important? Well, I think the banks would love to continue to raise interest rates, but they're finding it difficult because of what's happening when they do raise rates. If you were to look here in Canada, you look at mortgage rates today, obviously at a high point that we haven't seen in quite some time. Right now, when a person pays their mortgage every month, that payment is making up 20% approximately of the income that household is taking. One of the highest levels we've seen in a while. So we are seeing that the average person here in Canada is and has taken on more debt. Our visas are a little bit higher than they once were. We're seeing banks taking on or setting aside more money for bad debts. And so the Bank of Canada is a little concerned that if they continue to raise rates, that people will find it even more and more difficult to get by, to go out and to purchase items and to do all the things that they would like to do. And we have a couple of charts showing the debt levels in Canada and how much they've moved higher. The first one here, borrowing costs, you can see the numbers basically show household debt versus the country's GDP. And I think what's important to notice here, in 2010 in Canada, 95%. Now we're well above 100%, second highest to Australia. Another chart we have as well is mortgage payments. And I think the one thing to note from this chart here is that about 1/3 of mortgages have had their payments increase. And this will rise to nearly all mortgages over the next 3 years. And so that's a powerful thing. And when individuals are paying more for their mortgage interest payments, where they're paying more interest on their lines of credit, they obviously have less money to go out and spend in the economy, buy big ticket items, go out and travel, etc. And so the net effect is a slowing economy. And so again, this is why central banks are in a quandary. They don't want to raise too quickly, because if they do, it will affect other things. And if you look at the US, you don't have to look any further than some of the banking issues that they've had, right? The bank failures, obviously raising interest rates as fast as they have, that affects the banks. Net interest margin starts to shrink. So the margin between what the banks pay on as interest and what they charge as interest, that starts to shrink because now they have to pay out more for savings accounts, more interest on GICs, etc., or fixed income products, depending on what they are. So overall, we're seeing the central banks have some issue and may not be as quick to raise interest rates going forward. And I think it's important for individual investors to consider this, because this may be a bit of a good thing, a bit of a green light for investors. Because if the Fed stops raising rates, or at least pauses, we know the Bank of Canada has paused, and if the Bank of Canada doesn't continue to raise rates, in my opinion, this will be a good thing for individual investors. The second point that I wanted to make as one for individual investors to consider before you make your investment decisions is market breadth. And it's a term that unfortunately a lot of people don't know, but it just refers to how widespread this market rally, as we're seeing this year, and we are seeing a rally, is. And a couple of interesting charts here. One is on the banking index. I talk often about how well the technology space is doing and how much the technology sector is leading the market. Yet when we look at, I guess, a chart of the bank ETF, which we have here, we can pull up, you'll see how badly the banks have done. This is a bank ETF in the US. Banks have performed quite poorly. Pharmaceuticals have not done well. The retail space hasn't done well. Yet what has done well has been technology. We have a chart of the QQQ, which is a pretty good chart. Invesco QQQ basically invests in the top 100 tech stocks. And you can see how well this chart is, or how well this sector has done. So once again, if you were to take the top 10 names, big cap companies, which happen to be mostly technology, and you were to remove them, in the US, you probably see the S&P close to flatline, or maybe even slightly negative. But because these tech stocks have done so well over the first, let's call it 5 months of the year, this has carried the stock market higher. And lastly, in this area, this point that I wanted to make, we have a couple of stocks in particular that I've spoken about many times. One of them being NVIDIA. Shares of NVIDIA have rallied tremendously. This is a share price of a few days back, so not exact share price today. NVIDIA has actually gone over $400, and it's just been a fantastic stock to own since last fall. Another stock here is Microsoft. You can see how well Microsoft has done and how much it's also carried the index forward. Not only the NASDAQ, but also the S&P 500. Keep in mind, technology makes up something in the vicinity of 40% of the S&P 500. So when tech is going well, so is the S&P. So when you go to make your investment decisions over the next few weeks, I think you want to consider owning one or two of these big cap tech names, because I think you need to own them for growth. And it's not something that I think you want to trade. These are names that you want to buy and own. Maybe trim some of the profits over time as they move higher. But I think you always want to be in them because they make up such a large component of the growth of the S&P 500 and the overall market. So let's get to the last point, or the third point I wanted to discuss with respect to what you should consider before you make your investment decisions. And this is being a contrarian. And really, we have one chart here, and I think it's a great chart. And that's a chart on Meta, or formerly known as Facebook. And it is probably the best contrarian chart I could show you. And again, being a contrarian means you're buying when those are fearful, and you're selling when those are buying. NVIDIA, for example, is a name I've actually been selling a little bit of as it has moved higher, because I think that's the prudent thing to do. That is risk management. You don't want to let all your eggs ride in the basket. What happens if something were to pull back? But Meta, and we can show the chart again, but Meta is a name that has gone up significantly since it reached its lows back, I guess, last fall, somewhere around $90 a share. Stock today is well over $250 a share. So being a contrarian investor, buying those names when others are fearful of buying, that is the way, in my opinion, to get ahead, to grow your wealth and your portfolio. It takes an iron stomach to do it, but if you can do it, it makes a lot of sense. And today, as I said, with market breadth being so narrow, there are a lot of ideas out there that are trading at low points, even with the market in general moving higher, that I think you could take a look at a lot of names to look for these names before you make your investment decisions.